Hey everyone, welcome back to Corporate Decoder, the place where we dig through corporate filings so you don't have to. Today we're diving into Hovnanian Enterprises' latest report, and let me tell you, it's a bit like a roller coaster ride, hopefully one that ends with them building more houses than owing more money. This report came out in late February, so it gives us a snapshot of how they were doing at the start of the year. The main thing here is the company's financial results from the first 3 months of the year. Hovnanian, for those who don't know, is a big home builder, so this report tells us how the housing market is treating them and maybe how it's treating all of us. Now they throw around some fancy terms here like EBIT and EBITDA. Basically, these are ways to look at the company's profits without including things like interest payments or taxes. It's a way to see how well they're doing at their core business, building and selling homes. They also use something called adjusted EBITDA, which takes out some unusual items like debt costs to give an even clearer picture. They also talk about what they call non-GAAP measures. It means they are using their own way to look at their numbers, not that they are following the standard way of accounting. They say they're giving you all these numbers, but at the end of the day, you should still look at the net income, which is how much money the company actually made, following the rules everybody has to follow. The company mentions home building gross margin percentage before cost of sales interest expense. This is like how much money they made per house they sold before subtracting expenses. It can show us how efficient the company is with its operations. They also like to adjust income before taxes, which is useful to exclude certain things that can impact earnings. This can help paint a clearer picture of what is going on with the company. Another interesting point is adjusted investment, which is about how much money they have tied up in land and materials, basically everything they need to build houses. Lastly, there's something called adjusted EBIT ROI, which tells you how well they're making money off their investments. It's a way to see how efficiently they're using their resources to generate profits. Now let's check out the actual earnings report and see if we can make sense of those numbers. Alright, so here are some key financials. Let's see, I'm scrolling through. Revenue was over $500 million. That is some serious money. It shows the company is selling homes at a large scale. Now let's see how that looks compared to last year. The company is doing a lot better than last year. Seems like things are looking good for Hovnanian. Net income was $20 million, which means that after they paid all their bills, they are in the green. That means that they are doing pretty good. One thing to keep an eye on is the cancellation rate. Almost 20% of their sales are canceled, which may be a cause for concern. It seems like they have a decent amount of cash in hand, which is good for being able to make their expenses. So what does all this mean for Hovnanian? Overall, Hovnanian seems to be on a decent path right now. Revenues are up and they're making a profit. They're also sitting on a good chunk of cash. However, that cancellation rate is a bit of a red flag, so it's something to watch out for. The housing market can be really unpredictable. Interest rates, economic conditions, and even just people's feelings about buying a home can change quickly. Hovnanian, like all home builders, is sensitive to these changes. So, is Hovnanian a good investment? Well, that depends on your risk tolerance and what you think is going to happen in the housing market. Their debt is still something to keep an eye on, but the recent results are definitely encouraging. Thanks for watching. If you found this helpful, please like, subscribe, and let me know what company you want me to decode next.